Thank you, Mr. Mayor. I'll just introduce Bill, who is one of our financial advisors from Alaska Permanent Capital Management, and he was with the council a few months ago presenting our yearly report. There were a lot of questions and interest from the council in having a bit of a deeper dive to look at our investments and discuss the council's interest in how those will be potentially moved between our funds. So we brought back Bill. He's with us, and Bill, I'll let you introduce the members of your team that are joining us online, but thanks for coming back and providing the additional analysis.
Absolutely, thank you. With me is Brandy Nikolai. She's my partner at Alaska Permanent Capital. She's the CIO of Multi-Asset Strategies. We work very closely when we oversee all the assets for the, Alaska Permanent Capital Management. Now, her group has done a lot of the modeling that we will dive into within this presentation. If you remember, as I spoke last time, one of the things that we came across was the equity allocation in your guys' overall portfolio had increased from the original allocation of 23% to 33%. And that was something that I showed you guys, and that on an annual basis we should review that and make sure you guys are comfortable with that risk within the portfolio. The second issue that will arise as we see is in the short-term account. There's only $500,000 left, approximately about $500,000 in that account, and we need to replenish that for future needs. So with that, we'll start on the first page, and I just kind of want to get back to the basics. And you guys have seen this page before, but there's one change that I want to point out to you here. We manage 4 basic accounts for you guys, but I've kind of taken the trust account out of this document, and I just want to focus on these 3 accounts. The short-term account, our relationship started with you guys in February 2005, and then in April of 2015, the portfolio got split up into 3 different buckets. The market values as of March 31st, when you combine those, is a little over $21 million. You guys have had contributions of a little over $40.9 million in the portfolio, and you guys have withdrawn out of the short-term account at $27.2 million. But this next line is something that I want to kind of take a second and stop there. These are the returns from April 2015, and April 2015 is when the portfolio got split up into 3 buckets. And we can think about this as if we stayed in just the short-term account the whole time since 2015, that all your return would have been about 1.60%. At that time, because of due low interest rates and not needing a portion of these funds, it was decided at that time to break the portfolio out into 3 accounts: a short-term account, which has secure, it's 100% fixed income securities, ranging from 0 out to 3 years, and your medium-term account. And the second one's your medium-term account, a little bit longer in duration, securities all the way out to 5 years. And that portfolio returned 1.93% on an annualized basis. So that's something that we would expect. We take a little bit more risk by investing in bonds that have a greater maturity, and we're able to produce 33 basis points in return. So that was a good decision to take $8 million out of the original allocation and move it out. The third is the long account, and it was in the original allocation to this account was $8 million. And since April 2015, this portfolio has returned on an annualized basis 6.92%. So when we take a step back and look at the decision that the council made and staff made during that time of that 2015, it worked out in your guys' favor to bucket the money and understand that you guys didn't need as much liquidity in that short-term bucket, in that short account, and by investing out into longer maturity fixed income securities, and also having a portfolio that has equity exposure in it, it did well for you guys. Now, as we go through this presentation, that long account has 55% equity and 45% bonds. But when we did our modeling, we incorporated all 3 of these accounts: the short account, the medium-term account, and the long term. So we combined all three accounts as we did this modeling. So as we move forward, when you hear me say about percentages of equity and things, think about it as an aggregate, all of that money, that 21 million put together. Good question. It's diversified, so they're not those two accounts aren't commingled. And so in the short-term account, we will have it's only treasuries and agency securities from 0 to 3 years. And in the medium-term account, we'll have securities from 0 to 5 years, treasury agencies, and there is, right, yeah. And when we broke this out, and this is an ordinance, and this is just kind of going back to on page 2, the intent of the account, and this is right from your ordinance. This was set up at that time, and in the short term, these are the funds that are in the short-term account are intended to be held for operating reserves of the city. So when cash in your cash accounts drop below a certain threshold, monies need to be moved from short-term account to your checking account to pay expenses. In the last 3 years, it's been about $1 million per year that's been drawn out of the short-term account into your cash reserves. When we set this portfolio up, this new bucketing strategy for you guys, there was, and if we can kind of go to the next page, the short-term account had about $3.4 million in it. The very first 2 years that the strategy was being deployed, there was no money being taken out of the short-term accounts. The next 3 years, there has been that $1 million taken out, and that's why we have about $500,000 left in the account. So now we need to think about where are we going to pull that money from, either the medium-term account or the long-term account, and replenish that short-term account for that reserves. All right. Any questions? You guys were fantastic last time. A lot of take and give last time. So when we go back, and I'm on slide 3 or slide 4, and when we set up the original strategy and put the bucketing in place, I was in front of you guys and we talked about budget stability and asset growth. And we have to weigh those two things. And even when we think about budget stability, and when we think low volatility within annual returns of the portfolios, but also it brings forecasting certainty. We know pretty closely how much interest returns are going to be returned from this portfolio. And then there's the other side, is the asset growth. When we add more risk to the portfolio or add equity, we're going to have higher volatility of our annual returns in that portfolio versus the other. But the forecasting ability for budgetary reasons is not as good on that portfolio if we try to budget or forecast 1 year in 1 year increments. Now, over a longer period of time, and we have some 10-year numbers here for you guys, based off our capital market assumptions, we can kind of have a little bit better idea of what these portfolios, how these portfolios are going to behave. So we got to think about that between budget stability and asset growth in the portfolio. And as we move to 5, this is another chart that you guys saw last time I was here, and it just kind of shows you, the short-term account again. As withdrawals have been taken, it's become a lesser percentage of the overall allocation. What started at 18% of the original allocation is now at 3% of the overall allocation. And again, as I mentioned, the 1 million lots that have been taken out on a yearly basis the last 3 years. So if that continues, we don't have enough money in that short-term account to fund that $1 million. So turning another page to slide 6. So there's 2 things that have happened, And I just want to take a second and kind of on the left-hand side, we see May 2015. This is kind of the original setup. In the long-term portfolio, there was 41% of the overall of the three portfolios. The three portfolios were made up about 19.4 million. About 8 million of was in the long account. 8 million was in the medium-term account, and also 3.4 million, as I mentioned, in the short-term account, which creates about 18%. When we kind of move down underneath that and we look at the equity, you guys had exposure about 4.5 million in equity exposure, which was about 23% of the overall piece of the pie. Now today, as 3 million has been taken out of the short-term account and we've had positive equity returns, and that long-term portfolio has outperformed that 6.92% on an annualized basis since the inception, we can see over here on the right-hand side that the overall portfolio has grown to $21.4 million, but that equity exposure is now 7.1 million. That's up from that 4.5 million, and that counts about 33% of your total portfolio. So the question that we're gonna have to walk through is, are you guys comfortable with that exposure, with that 33% exposure moving forward? Or do you guys want to dial back that exposure to the original allocation of 23% or a happy medium in between? And when I left here, I was under the impression that you guys wanted to see some ideas, what the original exposure, what that would look like, and then what it is currently based off our 10-year projections moving forward. So that's what we'll work through. Mm-hmm. Equity exposure? Let me take it. Because this is not a permanent fund, these are operating central treasury funds, there are not very many entities that have equity exposure within this, because a lot of them carve out and create its own permanent fund, and then that will have higher equity exposure than the 55% that you guys have.
Question on that. So what I heard you say was other entities typically don't have equity exposure? Is that what I heard?
Within their operating funds, yes.
Oh, okay.
But if I can make a lot of individuals don't have the amount of operating funds that you guys do. So just because they're operating funds, you guys have much more operating funds than what you guys go through every single year. We have some entities that have different bucketing strategies similar to yours, but they will draw down their operating funds basically down to zero until their tax revenue comes back in, and then it goes back. Where you guys have a plethora of operating funds, what is classified as operating funds.
Sure. Yeah, I think my question then is only going to the, just knowing where the sideboards are at. So going to the absolute extreme, what if we had zero equity exposure? Mm-hmm. I see the chart, and I know I'm skipping ahead. I'm sorry. It's a bad habit.
No, we can skip around.
I mean, obviously, there's a lesser return, but there still is a return with zero equity exposure, correct?
Correct. And I think if we go back to the page 1, if we think about having zero equity exposure, and you guys stayed with the same strategy for the last 6 years, your portfolio would have returned 1.60. Where you guys took 8 million, put it in a medium-term bucket of all fixed income, produced another 33 basis points or 1.93, and then you had that 8 million that you put in the long term, and it produced 6.92. So over a longer period of time, we would expect that.
So we can have variable equity. Equity exposure is only in our medium and long-term accounts, right? Or just long-term?
Just the long-term.
Thank you.
Yes. Councilman Carey, you look like you had a question.
Would it be correct to say that among cities, towns about our size in this state, we are doing very well in terms of these type of funds?
Absolutely.
Would you guess, and again, I don't know at all, and I'm not trying to, but would you say that maybe we're even the best? Well, I am trying to say, I think we are extremely fortunate. We have a significant amount of money, which I still think of as sort of a reserve, but I might be wrong. And so I'm just trying to, you're the expert, and I don't know where all you, you look at numbers. And I'm open, the councilwoman is correct. Anyway, we're doing very well.
Yes, yes, you guys are. And then I think you guys were very prudent back in 2015 when it was recognized that you guys weren't going to use these funds, that they were long-term, and understood that, yes, you guys can take some equity and equity allocation and take some variability within returns, and that you guys still had plenty of liquidity in case, something happened.
Just a quick reminder, we're recording this, so please speak into the microphone so it can be picked up. Thank you.
What would be the relationship between the term equity and profit?
The relationship between the two is when you introduce an equity exposure, your returns, and I got some graphs on this, a table on it, I should say, that the variability in the equity exposure will have variability in the profit. If you have zero and you have fixed income, your returns are going to be right around a certain threshold. But as you add equity exposure in, your returns are now going to fluctuate a little bit more. Now, over the long term, over a 10-year period, we should see that it'd be much higher because you're taking more risk.
Thank you.
One for me, if you don't mind, Mr. Mayor. Is that okay? Yeah. Sort of an odd question, but I think maybe one that would be helpful for me at least. We've taken out a withdrawal from the account, $1 million over the course of the last 3 years. Is there a threshold at which, because that has not decreased our fund balance necessarily by taking out that $1 million. Is there a threshold of return on this dollar amount at which that no longer becomes tenable and we would see a decrease in that fund balance if we weren't getting, let's say, so if we're getting 6.7%, you understand the question, I'm guessing, right? Okay. Mm-hmm. If we drop below 4.3 or 4.4, when does it become untenable?
I think when you look, if you think of $1 million on 20 million, 21 million, that's 2%? Is that 2%? 2.2%? 5%? So the threshold would be is if it's greater than.
Sorry, but we're only talking about equity exposure in the long-term account, which is not the full 20 million, right?
No, when we're looking at these pictures, when we're looking at it, there's only equity in that long bucket.
Right.
But all the statistics that I'm going to show you incorporates the whole piece.
The whole piece.
The whole
Okay.
piece. I'm trying to get you guys to focus on that whole piece because that's ultimately your guys' equity exposure over time.
Understood.
And we ran all of our scenarios based off of all three of those accounts as an aggregate.
Bill, I'll just say, Councilwoman Parker was correct. She did the math quickest in her head. So on the $21 million portfolio, if we can, on the portfolio as a whole, see 5% returns, then we can have a sustainable draw of about $1 million.
Okay.
$1,050,000. Is that fair? Yeah.
Yes, that's
Okay.
correct.
Thank you.
Just following up on that, I mean, if we have $20 million and we make $2 million, that's 10%. Okay, I guess anyway. Is there a number in terms of how much we have made in the last 5 years off the funds we had? If we added every year together, And that's where, again, I still think equity is involved. But anyway, is there, and it's probably here and I'm not on the right page, but is there some place to see the amount of return that we have received over the 5 years total? Obviously, if we take money out of it, we still made that return. And so I'm trying to see, and maybe that's exactly what the number is, what percent return have we received over the 5 years listed here? And is that,
I don't have, I can tell you, so I can tell you by year, since we've inception, the return numbers
okay?
for fiscal years, I'm gonna go 16, 17.
Is there a page that you're?
No,
reading
I
from?
just
I'm
have
sorry.
these written
Thank you.
out.
I'm sorry.
So the return is 2.12, 3.35, 2.65, 5.55, 4.47, and then fiscal year to date through April 30th is 10.9.
So those last 3 years have been the big ones out of the
Yep.
whole. Okay. Thank you.
And then kind of put it in dollar terms, you guys started with 19.4 million, you guys have 21.4 million. So that's a return of 2 million, plus you guys taken 3 million out.
Right.
So you guys have basically made, or returned 5 million on the 19.4 million over that.
Which would be about 25% total, but obviously it's on a yearly
Over
basis.
5 years, a little over 5 years, roughly 5%, 4.5%, 5%, yeah.
Right, right.
Yep.
Thank you.
So as you've looked at this, and this would be for Melanie and Stephanie, I see where Three Bears is going to build a facility in Sterling. And have you kind of identified what impact you might see that having on the city revenues? Given it any thought?
We have not discussed that. I think when Melanie and I do general forecasting in terms of sales tax revenue, our expectation is that the city's still going to continue to perform on a slight incline, do modest but consistent growth in terms of tax. I was on a call earlier today with remote sales tax. I would say we could probably project more aggressive growth in online sales. Some communities are thinking probably 20% growth even in the next year as more online sellers come online. But in terms of brick and mortar, we're usually projecting a very small 1%, 2% increase year over year. I don't know that that store in particular would have as significant an impact given the size of our tax base.
I don't think it won't, oh, there it goes. So don't you think, though, that when you look at Three Bears in Sterling, what you're going to do is you're going to get the people that go to Three Bears in Kenai might be splitting up and going to Sterling, which doesn't affect us anyway?
We haven't talked about it. We haven't considered it. I don't know the timing of that store, but we could look into it and have a discussion. Yeah.
I do have a question as well for Stephanie or Melanie. Are there specific rules for the? No, I guess I know the answer to that question. I was going to ask if there were specific rules for if we withdraw from our investment account to put it into something. That just is going into our short-term account and can be that's spent as the general fund on whatever we budget. Correct. There's not a specific rule for how we use the $1 million that we withdraw from there on a year. No. Okay. For example, we don't have to use it for a capital project, I guess, is the reason for my question.
Through the mayor, correct. So the money it just becomes either part of our cash that's available for any of the funding needs that the council has identified either through the operating budget or capital. It's not specifically in one lane. It's just of the projects you approve, of the operating budget that you approve. This is part of our cash on hand to be able to follow through with those obligations.
Okay, thank you.
If I may, just a follow-up question on that. Going back 3 years, I was just curious for what transitioned us to drawing $1 million annually on that. Was there a revenue shortfall where we turned to this fund to make that gap viable, or was there just, hey, we have this cash, let's start using it? I'm just curious what the history on that draw is.
I'll ask maybe Melanie to elaborate, but I can tell you one thing that has changed, not in 3 years, but in about 5 years, is that the state stopped giving cities money for capital projects. So this $1 million draw really has allowed the city of Soldana to continue investing in a capital budget every single year, maybe at a slightly reduced level from when we were getting many more millions from the state in a given year. But that would be one difference in kind of pre versus post the state giving those legislative grants, is that now this draw allows us, without significantly changing the balance of the portfolio in general, to draw that 1 million every year, which we invest in capital as well as operating.
Got it. So even though this isn't hard set to support capital investment, it does allow us to maintain status quo operations without drastically cutting our capital improvement plan. That makes sense.
It's also something that's been budgeted for in our budget. There's a line item in our revenues for investment earnings, which is specifically this. So it's part of our operating budget. We plan on using our investment earnings as needed.
Thank you, Mayor. So let's go back to page 7, and I just want to swing us back around before I go to the next 2 pages. I'm going to spend a little time on the next 2 pages with you guys, but we got to come back. There's 2 decisions that you guys are going to need to make tonight. One is, are you guys comfortable with the equity exposure in the portfolio and at the different levels, and try to, for you guys to decide on what equity exposure you guys are okay? And then the second is, based off the equity exposure, and these kind of go hand in hand, and I'm going to try to explain this to you here in a sec, to replenish another $1 million out of, to seed the short-term account with another $1 million, are you guys going to take it from the medium term, the long term, or both? Like 500,000 or 500,000 out of both of them and move them to the short term. So that's going to be a decision that will be brought up that you guys need to decide, so that staff can bring a resolution to you guys, because it does need a resolution for money to be moved from the medium or long term to the short term account.
Mr. Kerr?
In terms of the point you just mentioned, is that something that needs to be done in this work session, or is this something that we'll do at the council meeting? I'm assuming it's a council meeting.
So we would bring it back in a regular meeting as a resolution. I think based on the feedback that Bill gets and we get tonight about maybe the council's preferences in reallocating or moving any of those funds, that would be an action item on your regular agenda.
Could I have a follow-up on that?
Go ahead.
Will you provide us where we're going to stand budget-wise? Obviously, this year we have received a significant amount of funds that we weren't anticipating. So that in making this decision, for me, it'd be helpful to know if we're going to have additional funds in the current budget to actually add to the amount that we're using here. And so, at least for me, it would be very helpful. We've had things paid for that I think we also kind of paid for twice almost. But again, that's not the right terminology. But anyway, it would help me to have a sense of whether or not you perceive there's going to be money unspent. Thank you.
So let's go ahead and move to page 8 and slide 8. And I'm going to spend a little bit time on this to make sure that these different allocations are clear to you guys. If we move, if it's decided to take 1 million out of the long term, or out of from the medium term account and move it into the short term, your equity exposure will be maintained, and it'll be 31% of the funds. So I want you guys to think about, as I go through these options, the equity exposure, and I'm going to move from the most equity exposures down to the least equity exposure. So if we move $1 million out of the medium-term account, which is an all-fixed income account, to a short-term, our equity exposure is going to stay the same. So that's one option for us. The second option is we move $1 million from the long-term account to the short-term account. If that is the desired route, we'd move to, the overall allocation would move to 28%.
I'm sorry, can you repeat that? Or
Yeah.
I can just say what I heard, sorry.
Yep, yeah, please do.
So if we take 1 million from long-term to move it to short-term, that would move our equity from 31 to 28%. That's what I heard?
From the long term to the short term?
Yes.
Correct.
Thanks.
If we move, and then so let's say if you guys wanted to dial back your equity exposure even more to 26%, how would we be able to do that? Well, we would move 1 million from the long term to the medium term, and 1 million from the long term to the short term. So 2 transactions, and that will dial you guys back to the 26% equity exposure in the overall portfolio. Now, the fourth option is what happens if we just want to move back to the original allocation back in 2015? What would you guys have to do to get back to that 23% equity exposure? We'd have to move $1 million from the long term to the short term, and then we'd have to move 2.26 million from the long term to the medium term. So another. So I'm going to stop there, and I just want to make sure that you get, to dial back the equity exposures, that those are the options that I would, come across to be able to take care of the original issue to replenish the short-term reserves.
So in the long term, we're getting better return than in the medium.
Correct.
So are we limited in how many transfers we can do from long-term or medium-term? So if there isn't, since we're getting the good returns, why would we take money from the long-term account where we're getting the best returns?
Yep. I'm going to pause, and there's a slide in 2 and talking about turbulent times and looking at Horizon. When we look at Horizon, and let's go to that page. And this is slide 10. So when we think about a 10-year projection, we know that if we have equity exposure, we're going to return more down the road. But during a 1-year time frame, the portfolio could be down, it could be up. Most recent 12 months, the portfolio is doing really, really well. But when we do our modeling and we look at 1 year and we're looking at turbulent markets and we look at history and we run this over 5,000 paths and we start looking at the most turbulent times during those 5,000 paths based off of history and our forward projections. If we stay within the 31% equity exposure, and this is on the right-hand side, with any 12-month period, we can think about that the portfolio could lose 12%. At the end of 1 year period, it could lose 10.1%. So I think this starts talking about risk, and can you guys stomach the risk? And I use that word loosely, actually, in the sense of if I came into you guys and you guys said, well, Bill, we want to have 31%. Okay. And then all of a sudden, 12 months from now, or any 12-month period, I come back, and you look at 12-month returns, and you say, Bill, we lost 12%. And I'd say, yeah, exactly, we modeled that. But is that acceptable to you guys? And that's the risk-reward situation, because I think what you're getting at is down the road, and on the previous page, I can say, well, over time, we're going to have an annual realized return of 4.1% in that on an annualized basis, and that's really good. And we can keep trucking and pull the 2% out of the portfolio or 5% out of the portfolio. But at the end of the day, during that time, is 12% something that you guys are okay with? Now, I will say this, and going back to Councilman Carey's thought that you guys are in an excellent position. You guys don't need that money right away to fund certain projects. You guys have a little more time horizon on your hands. So that also plays into the situation too, as you guys are thinking, can we take this risk or not take this risk?
Question on your slide on page 10. This is not what you're projecting for the next year, right? These numbers, this is just a worst case scenario. Is that what I'm hearing you say?
Correct.
Okay.
Yeah, we start looking at tail risk. And Brandy, if you want to jump in here regarding slide 10 and the risk.
Right, can you hear me okay, by the way?
Yep, we can.
Okay, perfect. So in order to evaluate the probability of losing, a certain amount of money over a longer time horizon, what the information you're looking at on slide 10 actually does is it looks back in history and identifies the average loss experience during these extreme market corrections, and then determines, how much the average loss has been from a historical perspective. So when we look at the probability of loss in, these extreme market events, for example, let's say 23% equity exposure tells us that at the end of a 1-year horizon, it was not uncommon to be down 7%. But if you looked within that 1-year horizon, as you were experiencing the turbulence, you could have been down up to 8.5%. And so the idea here is to evaluate the lower probability event of extreme losses. So again, this magnitude of loss is only expected to occur about 2.5% of the time. Certainly, we just went through that with the recent COVID crisis.
A question either for Brandy or Bill. Brandy, this is Stephanie. My question would be, what's the timeline that these very turbulent market disruptions correct themselves within historically? Because it's pertinent to us observing that although it's not set up like a permanent fund, the long bucket, in many of our minds, we may think of it that way because we know we don't need those funds within kind of a shorter timeline of reach. Do we know the answer to that, and is it relevant to this part of the conversation?
It is relevant to this part of the conversation, and I'd say, for example, in the recent crisis, we experienced the most rapid recovery in history. And so the drawdown in the bottom of the markets was in March of 2020. And by August of this year, we had already recovered the full amount. So it just depends upon the specific crisis and the circumstances. At other points in history, it has taken, it could take a year or more to recover the total dollar amount lost during extreme market conditions. I would like to add some context here in terms of thinking about loss, because when we think about the risk of loss, I think it's important to differentiate between market risk and goal risk, because I think that, of course, none of us like to put ourselves into or envision ourselves in a situation where the portfolio is experiencing extreme loss just because that's what's inherent in the markets. I think in order to evaluate which level of risk is appropriate for your specific situation, you should think about risk in terms of goal risk. So should you experience a time period where the portfolio is actually down, 8.5%, would that prohibit your ability to support your budget or take your draws that you need from these assets? So I think that contextual or conceptual idea of evaluating risk within the context of your goals is helpful.
Based on the current market situation and the inflation rate and shortages going on, what's your crystal ball saying?
Our capital market assumptions, if that's on slide 9,
So from a multi-asset portfolio perspective, our team has taken a look at the recent inflation numbers. In particular, we got an inflation print today that was way above what consensus expectations were. And we do anticipate, as policymakers have actually communicated, that we're going to experience inflation pressures above the Fed's 2% target here in the near term as the economies reopen. A lot of those inflation pressures are anticipated to be transitory or short-term in nature until the supply and demand dynamics equalize after supply actually comes on fully as economies are reopening. I think that the markets could be in the near term subject to some volatility as investors try to sort out whether or not that inflation is indeed transitory or whether or not it's more sustainable. I think the key aspects in order to determine how sustainable inflation is has to do with overall inflation expectations, which remained anchored today. So that's very important. It indicates that the Fed can remain very patient in their policy decisions. Also, when we're looking at sustainable inflation, I think wage pressures are also important. Those will be things that we'll be watching as we get more information in terms of price pressures in the coming months. But the next 3 to 6 months will probably be important in terms of playing out the differences between transitory and more sustainable inflation.
Mr. Carey?
Looking at, I'm trying to see if, I'm trying to reach understanding. If we went 12 months ago, the market was at 22,700, and today, after dropping 681 points, it's at 35,000. So again, 13,000. It's the highest. 2 days ago, it was the highest it's ever been. It would seem to me that part of our decision would be that there are some stocks that are pretty much, people have to have them almost regardless, okay? And those are the relatively safe. There are those things that, again, are more moderate, and there are those things that, at least looking at it, and particularly if we go back to a few years, the market is higher than it's ever been by a significant amount. It's been going up just outrageously. And so that, am I correct to assume that if today we decided to take all the money that we have, the numbers you had, out of this account, then it wouldn't matter to us what the market did. If we didn't have anything invested in the market, we wouldn't have to worry about it. Is that correct?
You wouldn't have any market risk.
Right. And we'd have the money.
You would have all the money and there'd be no market risk.
Right, okay. So what we're talking about is approximately for the next 12 months, where do we want to put this significantly wonderful amount of money? And our question and what we're asking you is to predict, which I think is an impossible question to ask you. And if you can do it, then you better form your own company and make your billions, because that's what they've been doing. But in truth, in the last year, the growth of the market overall is the largest growth ever in history by a significant amount.
There is, yeah. I mean, we've had very good numbers.
Yeah, I've got them right here.
And as you pointed out, and I think there's some drivers behind that. It's
Absolutely.
not something out of thin air. There's been some drivers that we've come down from the lows, very, very lows. And also you've had about $5 trillion in fiscal policy that's been added.
Yes.
You've also had about $5 trillion in monetary policy that's been added to,
Right.
and that's just within the United States. And when you look at worldwide, and the monetary policy from the Bank of England to the Bank of Europe, or the European Central Bank, the BOJ, the Bank of Japan. So there's global central banks, a coordinated action among the central banks for the monetary policy. So yes, you can look and say equity prices are at all-time highs, but there is some things that are driving it to a positive direction.
Absolutely, and I'm always aware of my ignorance, but I'm going to say I don't expect the federal government to keep pulling out trillions of dollars, adding debt, and keep giving it to everyone wherever they can. So I think that there is a cushion that's been created by those, again, you use the firm, the 5 trillion. Again, they're talking about another 2, and they're talking, and so that, my point, from my standpoint, and I don't know anything, but I want to be real careful and not expect the market to go up a whole lot, because I think it's greatly inflated. And there are many other people that actually know stuff that say it's inflated, and that a much more massive correction would not be unusual. And so for me, helping from you would be how to invest our funds in very low risk, expecting the market to at best hold, but I'm hoping that a year from now the market will be down. Again, remembering that a year ago was at 22,000 and today it's at 35,000. It's a huge increase, assuming my little graphs here are right. And so that's what will be helpful to me as we move forward, is seeing how to be as conservative as I can be. I had 6 terms on this council. When we looked at the money we had, and we stored a whole lot because the state was going crazy in terms of how they were going to assign who paid off retirements. And if you can imagine, we actually had a year in which to take care of our debt, that they were saying at that time, we gave the state $1 million. They gave it back to us and said, no, we don't want you to pay off your debt because we think it's going to be higher. And we've held on to that. And so I want to be conservative because I've seen a long time, and this is such a wonderful, wonderful thing the city has done. And again, the management, you guys are awesome, but it's also management from a couple decades. And so for me, it'll be helpful to know how, relatively speaking, I see kind of half in moderate and about half in low. But again, that may not be the right way to look at it. But that's what will be helpful for me to decide, is if you can provide the ways to categorize this, to have, again, in my mind, half and half, but I'm not stuck on 50-50.
And I think, and I know there's a question over here. I think, can I entertain that as I go into 2, and I'll put pictures
Absolutely.
in dollars? Yes,
Great.
absolutely. Mr. Mayor, if we can.
Not only am I in the corner, I have a microphone that doesn't like to work. Anyway, my question is, of Stephanie, how much money are we going to need for projects this summer? I think that is a huge question to be answered before we talk about reallocating money anywhere. So do we have an idea?
Melanie, do you want to speak to that, or do you want me to answer? I think Melanie and I talked about this, and there's a few different things in play. One is the CARES Act funding. How much of that is allocated to our personnel costs, because that provides us some additional funding that's available. The second would be the timing of capital projects. Kyle's not here, but we had anticipated diving right into the Sports Center project. We believe that this is not the bidding climate necessarily to push forward with that project. So although we have not come back to the council yet to talk about the timing, we believe that there will be a substantial cost savings if we instead kind of go out to bid in the winter and do that work next year. So that, if that's our path forward, that would relieve the need for some funding right now. So Melanie and I were talking to Bill about the need to transfer $1 million into the short fund. We've got the approximately $500,000 there right now. If we could come back with a resolution at an upcoming council meeting that transfers $1 million, we would feel comfortable that that's sufficient with everything that's going on for our cash needs over the next year. And if anything, we come back at the annual review in the first quarter of next calendar year and reassess. But $1 million would be the number that we would be recommending at this time.
Right, because I've been watching building costs going up and up and up, and I mean, they're like 3 times more than what they were last year, so it's not a good year to do that. So I do agree that we need to move $1 million, but again, I still think we need to leave our long-term account alone. It's making good income. I don't foresee that any of those investments are volatile. Am I correct?
I mean, when you look at the whole portfolio, I can show you the volatility that we're showing in a 10-year standpoint, but there is some volatility on both sides, positive and negatively on that.
But I just think that we would continue to, I mean, since we don't need the money in a big chunk, we put $1 million out. If we take it out of the medium account, that is our lowest investment return. And if you look at the long run, just like you say, a year to 24 months, I don't think things are going to really, there's going to some that will go lower, but there will be others will make it up with going higher. So do you have an opinion on that?
Yeah, I think when you're looking at volatility within the in the confines of this portfolio is, we showed, and Brandy spoke to the, intra-horizon, and the volatility on any one given year period. You guys have the ability to take a little bit more risk because you won't need anything outside $1 million in the next year. So you guys have a little bit more time for that. You guys won't have to sell and dip into that long-term bucket in opportune times. And that's when we do this analysis with other clients is, the ability to take risk. Are you going to have to just go ahead and sell something at times in a market like in March when I was in front of you guys last time? It doesn't seem to be that that's the case. The other thing that I take out of it is when I was in front of you guys in March and we were having that correction, you guys were okay with, during that time, you guys understood that we're not in need to sell anything. There's money in the short-term account. We can withstand this pain that we were holding. And so for me, it was kind of an interesting time to be in front of a client at that time. And you guys are like, yep, I understand. It will come back. And did we think it was going to come back within 6 or 7 months? I don't think we foreshadowed that. I think Brandy hit it on. It was the quickest pace to return. But if we think of 2 or 3 years on a very pressured situation, you guys have the ability to do that within these funds, on that standpoint.
I think I'm fast coming to just a thought. I just had one further question before that full thought is together. It's on page 11, the Monte Carlo simulation. So what this seems to indicate, just from my limited understanding, obviously this is over the course of the next 10 years, or at the end of 10 years, right? It seems like that's what it's indicating here, what the projected growth or expected scenario would be. In the 31% equity simulation, I guess first takeaway I have from this is, in the worst case scenario, over the course of the next 10 years, our risk, if the worst thing happens, regardless of whether it's 23% or 31%, is a net movement of $200,000. Yes?
Correct.
Okay. In the current expected scenario, there's actually a pretty significant potential movement in the upward direction, and then obviously it gets pretty crazy if you look at the green line. That's a correct statement, right?
Yes.
Okay.
Yeah, I'm sorry, go ahead.
I guess my takeaway from this, and maybe my thought overall, is if we're looking back at some of our options, transfers, and resulting allocations from page 8, I'm leaning towards this medium term 1 million transfer from medium term to the short term account, leaving us at 31% equity. And for a very specific reason, I think, speaking to what Councilman Hutchings was kind of alluding to, we don't really have a specific need for these dollars currently. We are in this for the long term. I think my long-term goal, and something that maybe we can discuss as a group outside of this work session, is sustainability, right? We're not going to be reliant on the state, because the state is an absolute disaster area when it comes to trying to get funds for anything. If the city of Soldotna can be self-sustaining and we can use our well-vested monies to support the things that we need and the things that we have as projects going forward that are somewhat maybe outside of our current operating expenses, I would encourage us to do something that would allow these monies to help us in those ventures that we need as a city to undertake. I don't necessarily like it being something that we utilize for our operating expenses, and that's what I mean by something that we should probably talk about outside of this work session. But my understanding of what is before us seems to indicate we would be wise to incur growth if that is possible. And I say all that to say, I heard Councilmember Carey and the idea of, holy smokes, things got real big, and what happens when things get peaked? They go into a trough. But what I see over this 10-year horizon is a net change of nothing, whether we choose 23% or 31% if the worst happens. Granted, that's not taking into an account the apocalypse or something that really I honestly have very little doubt probably could happen at this point. But that's my thoughts, and thank you for your time, I guess.
Any other comment, Mr. Chilson?
Question, just a understanding check on this. So under our current operating model, if we get to the end of a fiscal year and we have a revenue surplus, is the current use of that revenue just to remain in the short-term bucket, or have we historically ever looked at moving a percentage of that to the medium or long-term buckets to fuel these? To Councilman Ruffordge's point, let's feed these and use these as a source of sustainability moving forward, so they're not just growing on their interest alone.
So the revenue that the city receives through taxes ends up in which account?
So the AMLET account hasn't been growing. So the growth case. Okay, got it.
Which is the reason why we have to replenish it with the short-term, the $1 million we've done over the last 3 years because the AMLET account hasn't had it.
Got it.
So during the summertime is when it mainly happens, as we're spending a lot of money on capital projects and waiting for sales tax revenues to come in and the timing of it. We need to make sure we can pay the bills when it comes to our operating, funds, and as well as the capital projects that are going crazy over the summertime during that time.
Any other comments or questions? Do you have anything else to add?
The only other thing that I would add, and kind of going back to other clients that have these type things, and if we can just, and I'll just finish up on slide 13, is, currently, the city manager or the finance director has the ability to move cash one way or the other, and into the short term bucket now. They can move money from the short term to the cash. And the thing I think about, and I just want to put it in front of you guys, I think this is down the road for, future discussion, is to have maybe, a basic guidelines on, mechanisms to transfer money. And there's kind of two big points, is what's kind of happening now when the short-term account gets under a threshold, and I just use $1 million just because that's what's been drawn the last couple of years, then there's a mechanism to move money from one bucket to another bucket. Another mechanism or a guideline would be like kind of a percentage of market value, meaning whenever the threshold of equity exposure reaches a certain point, right now it's at 33% or 31%. If it reaches 35 or 38%, then there's a mechanism that automatically moves money from the long term out. And it's just a risk control basis, nothing more, nothing less. It's not saying you have to do it or nothing, because at the end of the day, I'm going to, hopefully for years to come, I'm in front of you guys on an annual basis telling you guys what your portfolio is and all these things. But it's just, when we look at target ranges around a normal asset class or multi-asset strategy, and there's ranges behind, that's one way to kind of try to buffer risk, throughout the year. So I kind of just leave you that with one more thought that it's not going to get answered tonight, but when I'm back in front of you guys, down the road, is there a mechanism to automatically move money from one bucket to another bucket without going in front?
Ms. Queen?
Bill, a question that we hadn't talked a lot about beforehand, but you've mentioned a couple times, it would be typical for a municipality to have a permanent fund. And I'm wondering, and that might enable a municipality to accept higher levels of equity risk within that permanent fund. And I'm curious if you could speak a little bit about maybe why that option wasn't originally thought of in the 2015 original setup, and and also whether that might be something we should discuss and consider meeting the city's goals of, using this fund balance as a sustainable kind of revenue producer for the city for projects into the future. Is that something we should be talking about? Is it something that was considered before? Can you speak to that a little bit?
It was discussed, but at a very, very high level. It wasn't dived into because I think I'm going to push this back to you guys or to you and how a permanent fund. I know some of our clients, the permanent funds are built based off of land sales or thinking they have this pot of money, and then by resolution ordinance, then it gets pushed into a permanent fund. And how that process works, I don't know. And I don't know how that works, and being able to move that into more of a permanent fund type setting, and the rules that are apply to that, because once it's in a permanent fund, then it's much harder to take that money out to pay. And usually there's a distribution policy, things of that nature built around the permanent fund. It's there to protect the funds for future generations and things to that nature, where right now you guys could basically spend all this money. But as soon as you carve out a permanent fund, you put it off to the side, just like the Alaska Permanent Fund, it's there for future generations, and you can only get to spend what's based off the distribution policy. So I think that was part of it, and at the time it was, let's take the first step, and we know that there's a portion of this, and at the time, 8 million, we don't need that for any time, so let's get some equity exposure within that 8 million in the long term, bucket it out, and let's kind of stair step into this.
So I
Vice
think,
Mayor Parker?
Yeah. With respect to the first point on page 13, mechanism to transfer money, I'm comfortable with the mechanism that we have in place right now. Being the legislative body, it's up to us to make sure that we have the budgets, we take care of the budgets, that we make sure that our investments are handled properly. So I wouldn't at this point support making any changes to how we currently transfer funds within the groups. And we have a good city manager and finance director that keep an eye on things. So should there be an issue, they look ahead and make those projections. They come and bring that to us and alert us so that we are prepared. But I think if we were to change it to where the city manager or the finance director could make transfers, then 20 years from now, people sitting on the council are going to go, I thought the city had money. What did you guys spend it on? Where did it all go? So I'm happy with what we have in place right now.
Any other comments?
thank you, Mr. Mayor. I think we will prepare a resolution. I guess I would just ask, we heard from a couple council members, maybe their preference in terms of maintaining the current level of equity and doing that by moving $1 million from the medium to the short. I wanted to provide an opportunity if anyone felt that that wasn't the correct path. Otherwise, we'll go ahead and prepare that legislation for an upcoming meeting.
Speaking for myself, I'm inclined to stay with the equity and take the $1 million out of the middle account.
Ditto.
Go ahead, Mr. Carey.
I think it's legitimate to say that these funds have been a permanent fund dividend for the people, and that we have not had to raise taxes in terms of to have the money that we needed for the expenses that were there. And so I would say, although they may not think of it that way, we've been doing a permanent fund, again, in terms of using the 1 million, 1 million, 1 million. And so I think that idea, there's different ways, whether we give the money in cash to the individuals, or do we not increase or even lessen the amount of taxes they pay. And so I think we've been doing well. Somewhere I would hope we might discuss whether or not it is our intent as a city to take in more from taxes than we need for the purpose of building up a surplus, which can then give us a permanent fund. And that may not be the case here and now to discuss, but I don't think in the past we were thinking we want to overtax just because we want to build up something for the future that we can take out of. I think it's circumstances that led us to have funds, and we were real clear we didn't trust the state. But again, I think somewhere for this council, it's a legitimate discussion on whether or not we want to take in more money than what we need, particularly from taxes. Thank you, sir.
Any further comments?
I would echo that I'm also supportive of maintaining the current equity ratio that we have been. I think this has been a great asset to our city. I'd like to see it continue to be able to grow and help us sustain us moving forward.
City manager, do you, Mr. Rufford.
Sorry, I did want to go back to, I agree with what Lisa was saying regarding liking the current process for transferring. One of the things on that note, though, that I thought was an interesting point when you were discussing it earlier, and I just maybe had a question about it. When you said transfer something, and it goes back to, I think it was the slide on page 8, to keep us at the same equity level. Yeah. So if we have a percentage growth in the long-term bucket, so to speak, let's say it's 4%, and that equals $900,000 over the course of a year. That's extra, or growth, let's call it growth. That then, in essence, does increase our equity risk exposure, right? We would go above 31%. We would be at 33%. And it's only that transfer of $1 million to whatever that it gets used for that brings us back down to 31%. Is that an accurate statement? I'm trying to understand that movement piece.
That I was explaining earlier?
Well, you had mentioned it would be nice to have a rule in place that says once your equity, let's say it got to 35%, it triggered something that said, well, 35 seems like a lot, or 40 seems like a lot. We probably need to move some of that somewhere else. That was an intriguing thought to me. Not that we need to have a rule that says when our fund balance gets to, 500,000, we just transfer money, but the equity piece was the part.
Yeah, it goes back to when we look at budget stability or asset growth type scenarios, and we have clients that as soon as their short-term bucket drops below, they transfer money automatically into the account. That's just what they do. The mechanism that's talked about here about percentage of market value and on the equity exposure is a risk controlled in the sense that if we think about these 3 buckets of money, and every single year you guys are taking money out of the medium term and putting it into the short term, year in, year out, and you're depleting that medium term by $1 million because that medium term account is not going to generate $1 million, and you do that. And then that long-term account continues to keep building up, and your equity exposure keeps building up and up and up. Now, is 33% good? Is 40% good? 50% equity exposure or something up to that nature? Now, Councilwoman Barker is correct that every year I'm going to be back and you guys have that opportunity to say, and I do the exact same analysis for you guys and say, hey, are you comfortable with this risk of 40%, 50%, whatever the number is? But if something happens in the middle or, it just takes risk off the table and rebalances it until I can get back in front of you guys to talk about that. And that's only the mechanism. I'm bringing this because when I walked out last time, there was a question on mechanisms and what do other entities do. And once I kind of started looking through our clients and what they kind of do, I could put them under one of these 2 guidelines. Some are market value based, some are equity based within a permanent fund. And I just bring it to your attention.
Well, I appreciate that. I guess, and maybe that's a question for the group at large, and maybe a question for you as well. Do we have a number as a group, or do you have a recommendation of a risk exposure that would, put us maybe in a volatile position, or I guess I don't know the answer to that question, but I like the idea of there being a, I don't know, a threshold of risk exposure that we could put in place. I don't know what the group thinks.
Yeah. I think the other analysts or analysis that we could do with this portfolio is you mentioned distribution of $1 million, sustainability of what could you guys realistically sustain over a long period of time to take out of this portfolio. And Brandy and her team do this a lot more than my team does. Is looking at what kind of equity exposure and mixture of asset classes, and 13 or 14 asset classes, you guys don't have that many asset classes within this, and looking at what that looks like by taking $1 million out, or $1.5 million out, or $500,000 out, and what's that sustainability over a long period of time? When do you get into your corpus of your fund if you're taking out $1 million? Can you generate 5% out of this portfolio? Well, if you continue taking $1 million out, probably not, because I had mentioned that it's only about 4% that you can. We're suspecting this asset allocation among these three portfolios is going to produce 4%. Well, you're taking 5% out. If we save $1 million, that's not sustainable over a long term, especially inflation based. So we can do that analysis, and I think that's maybe another step. Another working session, next year, and look at distributions and the sustainability of that. Brandy, do you have anything to add to that?
No, I don't. I think that's exactly right. I think in terms of evaluating the loss threshold, I think it would be a combination of looking at sustainable distribution rates, as Bill just summarized, but then perhaps we could also look at the overall principal value. If you have a goal to protect your initial, investment, then we could evaluate at what loss threshold would each of the allocations experience a loss below your principal threshold. So we could do it from an asset-based perspective on terms of principal, and then also a sustainable spend rate, as Bill mentioned.
So, do you have an idea what the, good? I do like the idea of the threshold, though, and I think we should explore that. And at a certain point, get to 35% or 33% or whatever, to take a look at how we manage that. So I think that is a good idea. I did live in a community back in the 80s where they did start a permanent fund, and within a couple of years, it turned out to be not the best thing that was ever done, and so it was not a good idea, at least in that time frame. So, do we have anything else to discuss here at the work session? If not, then we'll go ahead and conclude now at 5:30.